Your phone explodes at 6 a.m. Screens are red. An analyst with perfect hair is explaining why this time is categorically different from every other time the market has recovered. And what do? You open your brokerage app. My name is Drake, and today I am going to show you exactly what happens to your money if World War III starts tomorrow. More specifically, what the people who lost everything and the people who quietly built wealth during every major conflict actually did differently. I glance at my watch because the difference between learning this now versus learning it during a panic is a decade of wealth. Before we talk about a single investment, I need to introduce you to the people rooting hardest for you to make the wrong decision. They are not foreign governments. They are not hedge funds. They are the financial media. Every time geopolitical tension spikes, viewership goes up, ad revenue goes up, engagement goes up. The more scared you are, the longer you watch. The longer you watch, the more money they make. Your panic is literally their product. So when markets drop 2% on a war headline and the Chiron reads, "Global markets in freefall," understand what is actually happening. A 2% drop is a Tuesday. They called it freefall because freefall makes you click. The entire ecosystem, the news segment, the expert, the platform, the ad, all profit from you doing the exact wrong thing at the exact wrong moment. Now here is the data point that financial media will never lead with because it would immediately reduce your anxiety and they cannot afford for you to be less anxious. Markets do not die in wars. They dip. The Dow gained 48% during World War II, 55% during the Korean War, 24% during Vietnam. The S&P 500 has delivered positive one-year returns after 71% of all armed conflicts since 1945. Why? Because wars are the most aggressive government stimulus programs in human history. When a country goes to war, it spends without limit. Weapons, fuel, logistics, medical supplies, communications, infrastructure. All of it flows directly into publicly traded companies. The government becomes the world's largest customer overnight, and it pays whatever the invoice says. That money has to go somewhere, and it goes into earnings. Now the most critical question: what do you actually do if World War III starts? Selling everything and moving to cash feels rational. History tells you something very different. The investors who came out worst in every major conflict were not the ones who held. They were the ones who sold and then watched the recovery from the sidelines in cash, which was quietly losing purchasing power the entire time they waited to feel calm enough to get back in. JP Morgan tracked this precisely. A $10,000 investment held in the S&P 500 from 2004 through 2024 grew to $68,000 if left untouched. Miss the 10 best trading days in that stretch, and you end with $29,000. 7 of the 10 best trading days happen within 2 weeks of the 10 worst. The crash and the recovery are practically the same event. The financial media covers the crash breathlessly. They barely cover the recovery because recovery is good news, and good news as a business model is basically worthless. So here is the framework. 4 steps, and the order matters. Step 1. Build the cash floor. 6 to 9 months of living expenses in a high-yield savings account. Physical cash matters too. When Russia was cut from SWIFT in February 2022, Russian citizens woke up to non-functional ATMs. Not because their money was gone, but because the digital infrastructure that moves it was switched off. Cyber warfare is the documented first strike tool in every major modern conflict. $2,000 to $4,000 in physical cash at home is not paranoia. It is a basic hedge against a short-term banking disruption. But here is where you stop with cash. Buffett said it directly. Holding excess cash during wartime is one of the worst things you can do with money. Wars are inflationary. Every dollar beyond your emergency buffer is slowly evaporating while real assets go up without you. Build the floor. Stop there. Step 2. Gold, 10 to 15%. But not for the reason most people think. The people who bought gold at the January 1980 peak during the Soviet invasion of Afghanistan waited 27 years to break even in inflation-adjusted terms. Gold is best bought before the crisis hits the front page. Right now, central banks have been buying over 1,000 tons of gold annually since 2022, the highest levels on record. This is not panic buying. This is institutional repositioning away from the dollar. When that is happening, the move is not over. IAU and SGOL both hold physical gold at near zero cost. Step 3. Defense, 10 to 15%. A $10,000 investment split across the top 5 defense contractors on September 18, 2001 was worth $94,000 20 years later. In 2022, while the S&P lost 18%, defense stocks outperformed it by 26 percentage points. European defense stocks have surged 255% since February 2022. This is not a war trade. It is a decade-long structural shift that conflict just accelerated. XAR is equal-weighted, so you are not overexposed to 2 companies. Better diversification than ITA for the same sector exposure. Step 4. Do not touch your index funds. CFA Institute data found that large cap stocks returned 11.2% annually during wartime, higher than the 10% peacetime average, with lower volatility. The war economy is a stimulus economy. Keep contributing automatically. If you have a Roth IRA, downturn is the single best time to contribute. You are buying tax-free growth at a discount. Investors, picture that morning now. Your phone is exploding. Screens are red. The person without a plan opens their brokerage app, sells everything, feels briefly smart, and spends the next year watching the recovery from the sidelines while the channel that scared them into selling runs ads for the brokerage that processed the trade. The person with a plan checks the structure they already built: cash floor, gold, defense, untouched index funds, puts the phone down and makes coffee. One of those people builds wealth. The other funds the system designed to prevent them from doing so. The time to become the second person is right now, not when the missiles are flying. Now, drop your thoughts in the comments. Thank you for watching and listening. Subscribe to Drake Financial so you never miss a video like this one. Turn on notifications because the next one might be the one that changes everything for you. Numbers do not lie, and now neither can your investment decisions. Stay tuned.